I know James and I have discussed in the past that if clients have over 3 million, $2.5 million, generally they can self-insure for long-term care. But for those kind of clients that don't have that kind of wealth yet, are still saving, maybe they have 1 million or 1.5 million, is there any sort of rule of thumb that you would say is a good amount of money for that client to spend? Like they don't want to be spending over 20% of their nest egg, for an example, for long-term care insurance, but is there any sort of general rule of thumb for people in that dollar range?
First, I'm going to address your 3 millioners.
Mhm.
Okay. It and I'll go back one step further. And James, you talked about this earlier too. This is an emotional plan.
Mhm.
And when you're thinking about financial planning and maybe estate planning and inheritance, I have seen more than once in the 3 millioners or up where they could afford to write the check, but their heirs
Mhm.
didn't want to spend it down.
Yep.
Okay. So having a long-term, and so then that senior person who has the money is now, they don't want their children to be involved in their care because they're very independent in their mind. They may not be able to physically take care of themselves and they want to have their own choice. But their children look back, wait, mom, I want that for our kids and, for college and all of those things. Having a long-term care policy in place, regardless of your financial wherewithal on the upper echelons, gives you choice and freedom, right? And so I'll put that for there. I will lean back to both of you on with your financial models on how much policy and benefit you should and premium you should align for your estate plan. But what I like to say in that vein, Luke, is you don't need to purchase a policy that's going to cover the full meal deal.
Mhm.
Do you need to have a Cadillac? Well, everyone goes into the showroom and that Cadillac is what's on the floor, but often we get taken outside, right, to the one that's affordable for us and still takes us down the road and it works great. But it doesn't have all the bells and whistles. So in that situation, I like to see a policy that's going to protect part of that financial plan that you guys are working on. You want to make sure that if that long-term care claim hits, it's not going to drain that plan. But know that some of that money from the plan will have to offset or co-share, like we have to do with co-pays and deductibles and everything else with all of the other things that insurance do. So position a plan that's going to work to cover a chunk of the claim, but it doesn't have to cover the entire amount of the claim. Does that answer your question?
Yep. No, I just wasn't sure if there was a general rule of thumb, but I know it's very specific to every client situation, like James and I discuss with clients. And we look into what your guaranteed income is, like James said earlier, pension, Social Security, any sort of guaranteed income that you have, because if cost of insurance is going to be $330 a day, but your Social Security is going to cover so much, then we don't have to dump so much into a policy to cover the gap there. So that's what James and I work on with the clients as well. Another sort of question would be, now that hybrid policies are becoming more popular, do you see more clients are going that route over a traditional long-term care policy? Just because they know no matter what, they're at least getting some benefit.
So there's so much more interest in them because of that, intrigue of having it be so flexible. I do feel that we have to go through the continuum of looking how a traditional policy works versus a linked benefit hybrid product works, because there is that price point difference. And if you can't get to that price point, a traditional policy is going to be perfect for you, right? I see people who could afford a linked benefit product that they go, I don't need the life insurance. I'm like, well, we're using it for long-term care. That's the position for this. But they just don't want to, they can't get over the hang up that it's a life insurance product. So there's more attention to it. I'm not saying that more people are buying those. It's still going to be that personal decision, but everyone needs to understand how they work and they weigh the differences off. And then they go back to design, finances, and what's going to work for their situation.
Mhm.
I've
Okay.
seen situations where we put a linked benefit on the husband and a traditional policy on the wife, or vice versa.
Okay, no, that makes sense.
There's
Uh,
different ways to skin the cat, so to speak.
Definitely. And this is probably going to be specific to the actual policy as well, but I know that traditional long-term care policies, the premiums can be tax deductible. If you're itemizing your taxes, it has to be over 7.5% of your AGI and so forth. With hybrid policies, I'm assuming part of the premium is still towards long-term care, obviously, but some of it's towards a death benefit. Is there a general sort of what percent of a premium for a hybrid policy will likely be deductible, or is it all depending on like what the death benefit is and so forth?
Excellent question. You have to look at the proposal, actually. You have to look at the physical illustration, and not all linked benefit products break out the LTC premium over the life insurance premium. So some companies, there's no tax deductibility of premium available like in the hybrid market space. Some companies will show you the long-term care rider premium, and then the long-term care rider options like inflation. And they'll break those out. So they'll show life insurance, long-term care rider, long-term care optional benefits. And those, anything with a long-term care could be considered towards the tax deductibility for premium. I'm not a tax advisor, I'm making my disclaimer, talk to your tax advisor.
Our famous words, yeah.
One other thing to add to there as well, is there's also some HSAs will allow you to take distribution.
Yes,
So I have a client now who they contribute to the HSA, and then for tax deductibility, they don't meet the deduction requirements for the long-term care. So they just pay from the HSA, and that's how they still go about it.
right. And also know that the tax deductibility might not even make sense now, right? When you purchase a policy, because if you have medical expenses that are exceeding 7.5% of your adjusted gross income, you probably might not be able to even qualify because you have medical expenses. But so I might purchase it today and not be able to, and the tax deductibility isn't going to apply to me. But 15, 20 years from now,
Yeah.
I could, right?
Yeah, or it could
So
also be like if you did a straight pay when you're later on in life, like at 60, a 10 pay is going to be more expensive. So, and maybe you retire early, so then your AGI is lower, and then almost all the premium, well, not all the premium, but a chunk of it is deductible.
I will make a disclaimer on that 10 pay and tax deductibility premium. Often there's guidance that maybe the whole 10 pay wouldn't be considered tax deductible. It would be what would be considered reasonable premium. So
Okay.
again, not tax advisor. It's something that can be considered, but there hasn't been any play on that yet. I will say for people in their 40s and 50s or business owners or wherever they are, it doesn't matter the age. There can be some also premium tax deductibility through C Corp is a wonderful opportunity. You can have a general business expense as long as you have it in your corporate filings that you're having certain people be covered through, the corporation is paying for the premium, and you can be selective who you do that with. It can be just business owner and spouse.
Right. And thank you. And just because of the time, we're a little over. I did want to touch very quickly too on, as you mentioned earlier, the biggest payer of long-term care, Medicaid, which just one thing we touched earlier on is kind of Medicaid planning, the 5-year look back. So one thing I've seen clients do, or and not directly through our advice, but working with an estate planning attorney, because this can get very nuanced, is creating a Medicaid trust or an irrevocable trust, and you move assets into this, and that gets it out of your state, and it gets it away from going against you when it comes to Medicaid qualification. But some of the caveats there too, and something we talk about with clients, is to do that, to take it so it's out of your state and it's out of your qualifications for Medicaid, it has to be pretty hard for you to access. That's part of why Medicaid found it. So it limits your access, and ideally it's done 5 years before you need care. right? So it's very rare that you are in a situation that you need care, but you don't need it for 5 years. So that's something, but it is a strategy that can be done and can save pretty substantial amounts. But I don't remember the expression you'd use where the sun, moon, and stars all need to be
Lined up,
they all
right?
need to be lined up. So it's something that I've seen work, but there's some pitfalls that we talked about specifically with clients, and concerns about, well, if best case scenario, you don't need care, but you've locked your money away into something. So kind of talk about that. Luke, if you could just for a moment touch upon too so in the disclaimer, we are not Medicaid attorneys, elder care attorneys, tax advisors, but just briefly touch on the Medicaid annuity you'd worked on with the client as well to help them qualify when it came to the benefits.
Sure. So recently had a client whose husband is in a full-time nursing home now. So in New Hampshire, you can only keep around $2,000 of assets in your own name. So that means her husband's name. But she also can't keep that many assets in her own name as well because they're married. So it's too late to try to do the whole let's hide it and get divorced because he's already needs it. So that's not a strategy, right? So she's allowed to keep as a spousal, I forget the exact wording for it, but basically like a spousal allowance. You can keep $137,000 in her name. And she's still young. She's in her mid-60s. So she has a long life ahead of her. Their assets level, they had about 500,000 or so. So she would have to spend 500,000 down to 137,000. And her husband would be able to keep 2,000 in his name, which his Social Security and pension is already more than 2,000. So basically, a way around it is that you spend down as much as you can. You get maybe home improvements, you get a new roof, maybe you get a new car because your car is older now so that you don't have to replace it. You get a new water heater. You try to do all the big ticket items on your house because all of that is part of the spend down. What's left over is that you can do an immediate annuity that has to pay based on her life expectancy with the remaining money. Other than the 137, she can keep that invested. It just, at the moment, it's off to the side. The rest of the money above the 137 after spending down on buying new roof and so forth, maintenance on the house, it can go into an immediate annuity that has to pay her based on the IRS guidelines, based on her life expectancy, a certain dollar amount or a certain percentage. And then that's fine, but generally it can only be for that. So if her life expectancy is 14 years, it can only pay 5 years or something like that. It has to still be in that rough time frame of life expectancy. If she lives longer, that's fine, but it can't be less. So it's a difficult situation. It's a lot of planning. I went to 4 different attorney meetings with the client. Unfortunately, I mean, her husband's been sick for a very long time, so it's not something that he would never even have qualified anyways, unless if he got a long-term care policy in his 40s. So it's a very unfortunate situation, and it puts a lot of stress on the spouse. I mean, when you go into a nursing home, especially if it's mental, like dementia, I mean, it's just a terrible disease, and it's really a lot of stress on the spouse, not so much yourself, because you're mentally, unfortunately, not there anymore.
You're being taken care of. Yes.
Yeah.
Yeah.
So
Well,
there's planning around it, but an easier solution. Granted, it is expensive, but as you can see, the benefits is if you lived half a year in long-term care, it's going to pay for itself.
right. Right. Exactly.
Yeah.
So there's obviously much more we could continue on, but wanted to touch upon the main areas and the slide again. It's the insurances, the equity in the home, whether reverse mortgage or selling a second home or something along those lines, the life settlement or self-insurance, and then again Medicaid planning. That's the Medicaid annuities or trusts or such, and then the long-term care insurance. So just because of the time, I will wrap it up here because I think we could go on for a while with all the different nuances. But as Stacy has kindly said as well, happy to continue these conversations on a more specific level, whether it's something concerned for yourselves, whether it's for your Parents is another big one that we discuss with clients. Happy to go over that. So please feel free to reach out to any of the advisors here at Brophy Wealth, and we will talk with you on your specific plan, pulling Stacy as needed. So thank you everyone for attending.